Our top story, it is likely to be another week of economic headlines. Governments around the world have now pledged about $4 trillion so far to try and stem the financial crisis, and central banks are expected to take further action. For more on this, we're joined by Tom Vassos, a professor at the Rotman School of Management. Thanks for joining us.
Hi, Jacqueline.
So, Mr. Vassos, we had the Asia-Europe summit yesterday end with, this agreement for the IMF to take on and continue a supervisory role in this crisis. Many countries are looking to the IMF for more liquidity to be injected into their banking systems. And we're hearing this week central banks are going to be lowering interest rates. What does this achieve in the short term?
Well, really in the short term, they're using one weapon that they have, which is monetary policy, to reduce interest rates, to really jumpstart the economies, or really what they're trying to do is soften the blow of some of the major things that have happened with respect to the global financial crisis.
Right, but the markets are a completely different arena, right? And when they open Monday, many people are expecting another volatile week.
Well, I think we're going to see volatility for quite a while, because you've got people around the world concerned about their investments. And let's face it, it may not be economic factors driving these things. In many cases, it's psychological factors. If everyone starts bailing out, you're going to see numbers going lower and lower.
So it's going to be people thinking, what the effect on retail will be, bailing out of retail stocks, those hedge fund holders still trying to perhaps continue to liquidate, right, to pay off losses.
Absolutely.
So right now we have a situation where the United States owns quite a large stake in its banks and insurance companies, some of the larger ones. This is all temporary, right? This is like a Band-Aid to try and, as you say, hold it together. But we have fundamentally this thought that we've got to rework, or at least really tweak, regulate some aspects of capitalism, some of the more volatile casino-like aspects of it, if you will. What kind of tweaking do you think is going to result, or what will we see? And will we see it at the G20, do you think?
Well, I think what we're seeing is we have the basic financial institutions in place globally to help address some of these concerns. The International Monetary Fund, you've got the G7's Financial Stability Forum and the World Bank. So organizations like that are meant to influence the direction of how things are going. The reality is we probably are headed for a global recession, which is defined as being less than 3% global growth. And probably an indicator of that is a couple of things. One, that the US and UK economies are probably already in recession. The Chinese economy moving from 12% to 12% to 9%. But also it's interesting, we're seeing certain industries that are leading indicators of that economic activities. For example, like the airline industry, where as we speak we have about a 3% drop in passenger volumes globally, and about 7% in Asia. So some of these indicators are pointing to slower economic growth globally.
What's your assessment, though? Is this a fundamental flaw in capitalism that it took, this kind of a scenario for most people to realize? Is this reworking necessary? Because there's the other school of thought that we don't need to regulate some of these more higher risk aspects of the system. We just need to let the chips fall where they may, and naturally there will be a self-regulation to this.
Yes, you have to get the balance right between financial innovation and financial governance and controls. And quite frankly, some countries like the US did not have that balance correct. Other countries, on the other hand, like Canada, where we do have a very solid and sound banking system with strong governance in place, really has weathered the storm quite well. So I think you'll see more and more countries around the world moving to a governance model that looks actually a lot more like Canada versus other countries around the world.
But the problem is we're all tied in, right? All these economies, all the markets are all tied in, and yet we have new economies like China and India, and increased trade with those countries developing. So is a reworking necessary quite clearly, would you say?
Absolutely. And what you're seeing is countries around the world have done a very coordinated effort to move very quickly. So what you've seen is they've put 5 basic principles in place of what they have to do: prevent bank failures, unfreeze the credit and the money markets, ensure that consumer deposits are guaranteed, that the mortgage markets are jump-started, that banks have enough money to lend. And so you've seen this coordinated effort, so it's good to see that they have been able to make that coordinated effort around the world.
Yeah, but quite a bit of short-term pain. You ready for this upcoming week?
It's going to be a roller coaster, sure.
Yeah, for sure. Tom Vassos with the Rotman School of Management. I appreciate your time. Thank you.
Thank you.